Hey everyone, welcome back. Ever catch yourself thinking about like the money side of those massive things companies own? Like buildings, equipment, even a whole fleet of those delivery trucks you see on the roads.
Yeah.
Well, we are going deep on fixed assets today, and it might sound kind of dry at first,
Hmm.
but trust me, this stuff is way more interesting than you might think.
Oh, yeah.
We're going to be looking at how companies actually keep track of these assets, why it matters,
Yeah.
and how it all connects back to stuff you see and use every day.
Exactly. It's something we see all the time, but we don't often think about it as, well, much more than things.
Yeah.
But there's a whole financial life cycle behind each of them, impacting everything from a company's, bottom line to their long-term plans.
Absolutely. And for our exploration today, we've got excerpts from CIMY, or as it's pronounced, Al-Nas al-Mulsak,
Right.
which lays out guidelines for accounting for fixed assets.
Mm-hmm.
Think of it like a secret decoder ring.
Yeah, a cheat sheet.
Yeah, for understanding this financial language around these assets.
Exactly. We'll be looking at how companies decide how long an asset will be useful, how deal with things becoming obsolete, and even some ways they can use accounting, to their advantage, let's say.
Okay, let's jump right in. First things first. What are we even talking about here when we say fixed assets?
Right.
Sounds pretty technical, but we're betting you see them all the time without even realizing it.
Oh, absolutely. Think about your favorite local coffee shop. That espresso machine that's, steaming away, the comfy chairs you're probably sitting in right now listening to this, even the building itself. Those are all fixed assets. They're tangible, so that means they have a physical form, and they're used in a business to make the stuff we all use and enjoy.
So not things that they're like constantly buying and selling,
Right.
more like the tools of the trade, right?
Yes, exactly.
The heavy hitters that help them operate day in and day out.
Now, according to our source, there are two main things that make something a fixed asset. First, the company using it has to think that they'll get some kind of benefit from it in the future. It can't just be a random thing they bought. They need to believe it will help them make money down the line.
That makes sense. I mean, you wouldn't spend a ton of money on like a big industrial oven if you weren't planning on baking and selling, I don't know, some amazing bread with it, right?
Exactly. And the second thing is that the cost of the asset has to be something they can measure reliably. You need good records to prove how much it's worth, not just a guess.
So it's not just about the initial price tag, right?
Right.
There's like a whole process of tracking all the costs that go into getting that thing ready to actually use.
Oh, you're absolutely right. It's not as simple as just buying a piece of equipment and plugging it in. You have to think about things like transporting it, getting it installed, any changes you might need to make, even training employees to use it.
Wow. I hadn't even considered all that.
Yeah.
Like a whole hidden, web of costs that most of us never even think about. And our source even mentioned like import fees as part of this.
Oh, yeah, for sure. And that just shows how global businesses are these days. You might have a piece of equipment that's made in one country, shipped to another, and then, changed and installed in a third.
Hmm.
All those steps add to the final cost.
So we're not talking about a quick trip to the store here.
Right.
This is some serious like accounting detective work.
It definitely can be. But it's really important for companies to get this right because the total cost of that asset, that fixed asset, has a big impact on how they report their finances and make decisions about, the future of their business.
Okay, so we've got this like shiny new asset all set up and ready to go. What happens next? I have a feeling it's not just smooth sailing from there.
You're right about that. Things break down, technology gets outdated, markets change. All of that affects the value of those assets over time.
Yeah.
And that's where depreciation comes in.
Depreciation. It's like that feeling you get when your brand new car loses value the second you drive it off the lot.
Haha. Yeah, that's a great way to think about it. Technically, depreciation is about spreading out the cost of that asset over its useful life. Think of it like paying rent for that asset over time,
Okay.
instead of taking one big expense hit all at once.
So kind of a way to acknowledge that it's not going to last forever.
Exactly. And there are actually a few different ways companies can calculate depreciation, and that's where things can get a little strategic. Our source mentions three: straight line, declining balance, and units of production.
Wait, there are strategies for something like calculating how much something loses value?
Absolutely. And understanding these can really help you when you're looking at a company's financials.
Okay, I'm all ears. Let's unpack each one so we can see what you mean.
Okay, great.
Okay, so let's break down these depreciation methods. First up, straight line. It sounds pretty simple,
Yeah.
but I'm sure there's more to it than that.
Well, you're right. There's always a little more to it. It is the most straightforward, though. Basically, it spreads the cost of the asset out evenly over its useful life. So think about it like paying the same rent every month for an apartment.
Okay.
Same payment every month.
Okay, so picturing our bakery again,
Right.
if they buy like a delivery van, they might use the straight line method to depreciate it
Mm-hmm.
because, it'll probably lose value at a pretty consistent rate over time.
Yeah, makes sense. Now, let's say they go for something a bit more high-tech, like a fancy automated mixing system. This is where the declining balance method might come in.
Oh, so this is where the strategy comes in.
Yeah, exactly. The declining balance method is all about taking bigger depreciation expenses in the early years of an asset's life and then smaller ones later on. This reflects the fact that some assets, especially those involving technology, tend to lose value faster upfront.
So it's like acknowledging that, yeah, that amazing mixing system might be awesome right now, but in a few years, there's probably an even better, faster model out there,
Yeah, exactly.
making theirs less valuable.
Exactly. And companies might choose this method if they want to lower their taxable income in those early years, which is totally legal and can be a smart move financially.
Wow. So
Yeah.
even depreciation has tax implications.
Mm-hmm.
Starting to see how much thought goes into these financial decisions.
For sure. And then there's the units of production method,
Okay.
which ties depreciation to how much the asset is actually being used.
Okay, this sounds interesting, like a hands-on approach.
Yeah.
How would that work for our bakery?
So let's say their fancy new mixing machine can make like 1,000 cakes per day.
Okay.
If it's running all the time, churning out those cakes, it's going to depreciate faster than a machine that's only making 100 cakes a day.
Right.
So this method, the units of production method, captures that wear and tear more accurately.
So if our bakery's like going for mass production, this is the way to go.
Right.
Because it links the cost of the equipment to the revenue that it's bringing in.
Yeah, exactly. So each method has its own ups and downs, and companies will choose the one that fits their situation best. What kind of asset is it, and what's their overall financial plan?
Yeah, this is making me realize that there's so much more going on behind the scenes than I think most people realize.
Oh, yeah, it's not just about the numbers. It's about understanding how these assets are being used, how their value might change over time, and then how those changes are reflected in their financial reports.
Okay, so we've got these financial reports looking all nice and neat. But what happens when something big changes? Like, what if the bakery's building suddenly goes way up in value?
Right.
Or that super expensive mixing system totally breaks down?
Those are great questions, and that's where the ideas of revaluation and impairment come in.
Okay.
Our source highlights those as key parts of fixed asset accounting.
Okay, so revaluation sounds good. Is it like winning the lottery when the value of your asset goes up?
It can definitely be a good thing for a company. It's all about adjusting what they call the carrying amount of an asset to reflect its current value. Think about like a vintage record player you got years ago. That might be worth way more now than what you paid for it.
Yeah.
That's basically revaluation.
Got it. So, like, if the bakery is suddenly in a super trendy part of town
Mm-hmm.
and the building becomes way more desirable,
Right.
they could revalue it to reflect that higher market value.
Exactly. It's all about keeping their financial records accurate and up to date with what's happening in the real world. Now, on the flip side, there's impairment, which is, well, not so great.
Impairment doesn't sound as fun. Is that like the opposite of revaluation?
You could say that. It's when the value of an asset drops a lot, and it's often due to something unexpected, like damage becoming obsolete or a change in the market.
Okay.
Imagine that expensive imported oven breaks down and the repairs are, crazy high. That could lead to an impairment charge.
Ouch. So they're taking a hit because something happened that made their asset worth less.
Exactly. Companies have to acknowledge that loss, and it can affect their overall profit.
Sounds like managing fixed assets at a bit of a roller coaster ride.
Yeah.
Lots of ups and downs. Got to be ready for anything.
Yeah, there's a constant need to look at things, reassess, and make sure their accounting reflects what's actually happening with their assets.
Now, remember how we talked about companies choosing depreciation methods strategically? Well, impairment can be a part of that too.
Oh, that's a really good point. A company might try to kind of downplay the chance of impairment to avoid having to report a big loss.
So smart investors need to look out for that.
Yeah.
Really dig into the assumptions a company is making about how much their assets will be worth in the future.
Definitely. It's about reading between the lines and understanding the risks.
Wow, this is really interesting stuff. We've covered so much. But I have a feeling there's even more to discover as we keep digging into this world of fixed assets.
Mhm.
You know, Thinking about revaluation and impairment, it really hit me like how much stuff outside a company can affect a fixed asset. It's not always about what the company itself is doing.
Right.
Like the whole world around them changes, and that can have a big impact on their, financial situation.
Absolutely. We often think of businesses as these, self-contained things, but they're really tied to the bigger picture of the economy.
Totally. Think about our bakery again. What if like a new highway is built that takes all the traffic away from their shop?
Oh, yeah.
Or like a major supplier suddenly shuts down. Those are things they can't control,
Right.
but it would directly hit the value of their assets.
For sure, the building might be worth less if fewer people are walking by,
Right.
and their specialized equipment might not be so valuable if they can't get the ingredients they need to use it.
So it's like this constant, like a chess game, trying to stay ahead of those external factors and make smart moves.
Exactly. Good business leaders are always thinking about those what-if scenarios.
Yeah. Yeah.
What could happen that might change the value of our assets?
Yeah.
And what can we do to, minimize those risks?
It makes me think about those huge construction projects we see.
Oh, yeah.
New factories, office buildings, even things like bridges and roads. Those are all big investments in fixed assets.
Mm-hmm.
And those investments can have a huge impact on communities and even whole countries.
You're right. It's not just about the buildings themselves. It's about the jobs they create, the money they bring in, and the chance for things to grow and change.
It's like this chain reaction.
Yeah.
Like deciding to build a new factory
Yeah.
creates jobs for construction workers, engineers, the people supplying equipment.
Right.
And then once the factory's up and running, they need more people to work there, so even more jobs are created.
And those workers then spend money in the local economy, which helps other businesses and just, boosts everything.
Yeah, it really shows how connected everything is. But let's switch gears for a minute and talk about when a company decides to actually get rid of a fixed asset.
Okay.
We touched on disposal before, but I'm curious, what makes a company decide to do that and what happens financially?
Yeah, well, there are a few reasons why a company might decide to get rid of an asset. Sometimes it just reaches the end of its useful life. It's worn out, too old, or maybe just costs too much to keep running.
Like retiring that old delivery van that's been costing a fortune in repairs and gas.
Exactly. Other times it might be part of a strategic change.
Hmm.
Maybe they are making their operations smaller or simpler, or maybe they're investing in something newer and better.
So like if our bakery decides to go from those old ovens to the super high-tech ones we talked about,
Right.
they might sell off the old ones to make room.
Exactly. And how they get rid of it can also affect their finances. If they sell it for more than what they call its carrying amount, that's the original cost minus all the depreciation, they'll actually make a profit.
So it's like selling that vintage record player for way more than you paid for it. Nice little bonus.
Exactly. But if they sell it for less than its carrying amount, they'll have to report a loss. Kind of like trading in your old car and not getting what you hoped for, It might be the right thing to do, but it can hurt a little financially.
Yeah, I get it. And then there's just scrapping the asset altogether if it's totally useless.
Right. If it can't be used anymore and no one wants to buy it.
So there are a lot of possibilities when it comes to getting rid of an asset, and each one has a different impact on the accounting side.
For sure. And all of this information should be clear and open in a company's financial reports. Investors need to know how a company is handling its fixed assets, good and bad, to make good decisions.
So it's not just about knowing the definitions and the accounting rules. It's about seeing the bigger picture, the strategy behind the choices they make, the stuff happening outside the company, and all the potential risks and rewards involved.
You got it. It's about seeing those things, buildings, machines, equipment, as active parts of this big, complex economic system.
Well, I gotta say, I thought this deep dive would be all about numbers and formulas, but it's been way more interesting than that.
Yeah.
We've explored the whole life of fixed assets, from buying them to getting rid of them. We talked about the strategies behind choosing how to depreciate them, and we even saw how they can impact things like jobs, whole communities, and the entire economy.
It's been a great journey. Really shows how even in a world that's so digital, these physical things are still so important to how everything works.
Absolutely. So next time you see a construction crane way up high, or a bunch of delivery trucks on the road, or even just a small business owner with their tools, think about that whole world of fixed assets that's going on behind the scenes.
It's a world worth understanding, and once you know its language, you can see businesses and the economy in a whole new light.
Thanks for joining us for this deep dive. We hope you enjoyed it as much as we did.
It's been great sharing these insights with you. Until next time, keep exploring, keep asking those questions, and keep diving deep into the fascinating world of business and finance.